Before you go out and start buying the dip in the market right now, this is a video that you have to understand all of the contents and information in it. I have seen a lot of people asking, is this the time to buy the dip in the market? Guys, unless you have an already scheduled dollar cost averaging plan in place, this is a very dangerous market to be participating in right now, not only due to the levels of uncertainty surrounding these new trade policies and future monetary and fiscal policy, but also the fact that many people are focusing on completely the wrong thing. And again, we're going to talk about everything that's happening in the market, in the economy, in this video right here. I'm going to provide you guys with some insight that I don't think you guys are really going to see anywhere else. So again, buckle up. We have a lot of information to cover in this video, guys. Make sure you guys share this one with a friend. Maybe it'll help them from making some silly decisions in the market in the short term. So before we get into all of that information, guys, again, we have some craziness to talk about with China, with Jerome Powell, with inflation risks, with growth risks, with sentiment. Where could this market go next? Before we end up covering all of that, make sure you guys go down and hit that like button if you guys do enjoy the information and analysis I provide for you guys in these videos here. Let's see if we can get this video to 500 likes. That would be absolutely awesome. And again, if you guys never want to miss another video like this, make sure you guys are subscribed and turn on notifications so you're notified every time these videos go live. We're trying to hit 90,000 subscribers here. That'd be pretty awesome to hit by my birthday at the end of May. But let's get into it over here. Don't want to waste too much of your guys' time in this little beginning section because this could end up being a pretty long video here. So the S&P 500 ETF, the SPY today, is down around 4.4%. Very, very aggressive movement to the downside there. We came down and really sniffed this 510 area that, again, I was kind of highlighting here for my private community. If you guys are interested in hopping in there with us, make sure you guys check out those links down below. But again, this is coming off of the trade war escalating as China hits back with 34% tariffs on all U.S. goods. Now, again, for those of you guys that don't know, the United States reciprocal tariffs, they're not really reciprocal. If you look at the calculations there, we've talked about this in prior videos. They're effectively trying to balance out the trade deficits with these tariffs, which is quite honestly a very silly way to go about doing this. But again, there is still a little bit of room here for some negotiation. China doesn't look like they want to come to the table here, but Vietnam does. This is from Donald Trump on Truth Social. Just had a very productive call with To Lam, General Secretary of the Communist Party of Vietnam, who told me that Vietnam wants to cut their tariffs down to 0 if they are able to make an agreement with the U.S. I thanked him on behalf of our country and said I look forward to a meeting in the near future. As we go into this weekend here, guys, again, this could be a widespread development that starts to happen with a lot of these different countries here. Either they come out and retaliate or they start coming to the table. But again, until we really get through that April 9th period, there is still going to be a lot of uncertainty baked into this market because we don't know at this current time for 100% certainty if all of these tariffs that were released earlier this week are going to actually stick and be put in place for good. Now, in addition today, we also received some comments from Jerome Powell. We did have a little question and answer session, and these comments are so critical, and you have to understand where the Fed is coming from two different perspectives here. One, it does make sense when they talk about their wait and see approach on what they want to do with interest rates and all of the other elements of monetary policy that they can manipulate next. But some of the reasons that they're citing for this caution here not only are really unwarranted, and I'm going to go through that in this video with you guys here too, but by the time we could be ready for some interest rate cuts, the Fed could be well behind the curve and way late to the party. So the first one here, Powell says prices don't go down. People know they are paying more and right now and are right not to be happy about it. Remember, inflation has come down significantly, but just because inflation is moving down doesn't mean that prices are going down. It's just talking about the rate of change of prices. Now, moving on over here, Powell says that tariffs highly likely to generate a temporary rise in prices. Now, that is possible here, but I'm going to show you guys why, one, even if this does happen, it is most likely not going to be a long-lasting effect. And the Fed this time around might actually be correct in saying that inflation is transitory. When we move over here again, This is starting to get into one of the most important parts here, that the Fed is really just missing the point here. And I don't want to sit here and say, oh, I'm better than the Fed. But again, when we take a look at all of the incoming data here, guys, a lot of what they're saying doesn't hold a whole lot of weight here. The Fed does not have a probability forecast of a recession, but outside forecasters have raised that probability. So they're not really focusing right now on the potential of a recession. As you guys can see down here, this commenter is posting this chart that we've talked about a lot, that this Atlanta Fed GDP now, real GDP estimate for Q1 is absolutely falling through the floor. Recently, it did start to pick back to the upside, but the projections for this are still negative. And when we go back and take a look at some of the comments from the FOMC meeting minutes from the December 2024 meeting, with regard to the outlook for inflation, participants expected that inflation would continue to move towards 2%, although they noted that recent higher than expected readings on inflation and the effects of potential changes in trade and immigration policy suggested that the process could take longer than previously expected. This was the notice from the Federal Reserve that really started the decrease in the projections for rate cuts this year. And when we come back a little bit higher here, I believe the staff continued to view the uncertainty around the baseline projection as within the range seen over the past 20 years, a period that encompassed a number of episodes during which uncertainty about the economy and federal policy changes were elevated. The staff judged that the risks around the baseline forecast for unemployment and real GDP growth were balanced. As concerns about downside risks from a marked cooling in labor market conditions has eased in recent months. So they are not really focused on growth moving to the downside. They are more focused on inflation. Now, here's the problem with that. Before we actually talk about this situation from a macroeconomics perspective, let's just take a look at some of the larger inputs to CPI. We have oil absolutely falling through the floor. Oil is in almost everything: transportation, production, electricity, shelter, absolutely everything. The price of oil is falling through the absolute floor. We can see here lumber's down, wheat is down, soybeans, corn, sugar, coffee, cotton, rough rice, cocoa, everything is moving to the downside. Gold, silver, platinum, copper, palladium, everything is starting to get significantly hit, and just this could provide a little bit of downward pressure on CPI PCE here. Now, the one thing that a lot of people are not thinking about right now, and as it relates to the broader context of what we're seeing here, is consumer sentiment, and as it's going to relate to the demand going forward for a lot of goods and services. So as we've seen, demand has started to, consumer sentiment has started to significantly move to the downside here, okay? So consumers are very, very uneasy about the prospects of this economy moving forward in the year 2025 and beyond. We can also see this reflected in personal savings rates. Ever since the beginning of the year, people have been saving more money. Well, I know a lot of you guys have seen that the one-year inflation expectations are moving to the upside, about 5% right now. The 3-year rate is moving up. The 5-year rate is moving up. Now, it is possible sometimes in those types of environments that you see people going out and spending in the present, but if the overall prospects of the economy are not going to be good, their demand is going to drop and they are going to start saving more money. And this is when we start getting into a little bit more economic theory, which again, the Federal Reserve should be paying more attention to. They should be more focused on what's happening with growth and less focused on these potential upside risks to longer lasting inflation that Powell was talking so much about today, which I'm going to show you guys really isn't that big of a risk here. Like taxes, tariffs clearly reduce aggregate demand in the United States and globally. When we take a look at this chart right here, if you see a significant increase in aggregate demand, well, then prices can go up. But the same thing is true if this line were to shift this way. And I want you guys to think about the actual potential cost increases if these tariffs are going to stick. With the overall sentiment in the economy right now, I think it's very, very unlikely that consumers are going to continue to spend at the same level and volume that they were before these tariffs. That is what this inflation argument completely hinges on, that the consumer is going to somehow just say, screw it and bite the bullet and continue spending at the same levels, but we can already see that personal savings rates are moving to the upside. Now, just to kind of make this a little bit more simple for everybody, I do have a tweet about this. This level of tariffs will reduce aggregate demand. Lower aggregate demand is going to call for lower prices. Lower prices lowers margins from a lot of these big corporations. Lower margins lowers growth, and also is not going to increase inflation because you have a significant decrease in the amount of demand for these goods and services. The argument for inflation ripping back up to 5% this year solely rests upon the fact that consumers will continue to buy at the same level. With sentiment this low and savings rates moving up, I just do not see how that is possible. Now, Donald Trump did come out today and also say that this would be a good time for Jerome Powell to start cutting rates, but as we saw from what Powell said today, is that he's in no rush and he does not think that the Federal Reserve is going to be cutting interest rates in May. So what does this actually leave us with? Well, we have a couple of things to discuss. If a lot of these other countries come to the table and the overall effective tariff rate ends up dropping significantly because you're able to effectively set up more free trade in the global economy, then you might not see these giant downward movements in growth throughout this year. But if you see a trend start very similar to what China did today, well, one, the market is going to continue to move down because, again, they're focusing on growth slowdown and what the earnings and margins of these companies are going to be, not necessarily the price increases. The price increases are going to lead to that lower demand. And again, consumers are just not going to be spending the same amount of money and the same amount of volume as they were previously. Now, on the fiscal side, we have heard of some plans for deregulation and tax cuts from this new Trump administration, which is going to happen if you want to stimulate this economy a little bit in order to not plunge into a recession there. But then you have the Federal Reserve that can really kind of tip the scales here with lowering interest rates once we start to get that movement down in GDP and growth. And they have told us that they are not looking to do that in the short term here, and they are fine playing that wait and see game, which could lead to even more downturn in the market. But again, at the end of the day, guys, these are all of the factors that are influencing things right now. And after hearing all of that, especially for me, this is not the time for me to want to go out and start buying the dip here. We could easily see a lot more downside in this market if that kind of outcome where a lot of these other countries are going to start retaliating, we see that growth slow down, and Powell and the Federal Reserve is still going to be worried about these inflation risks and not necessarily the growth risks, which they should be, we could easily see the market continue lower. So what we really need to see here is that confirmation of one of these paths, and then go from there. Because again, you can't just make these knee-jerk reactions in the market, especially if you are a new investor. We've gone over this many times. I've been talking about this with the private community that, again, you have to be smart with where you are allocating capital in this market. With that three-pillared approach that I always talk about with you guys, the high-level approach is understanding the big picture and the overall macro environment and where things are most likely going to head next. With what we're seeing right now in the broad market here is that the outcome of what happens next is very uncertain, and we have two very distinct paths and also some kind of forks in those roads as well as we go along those paths. But we haven't necessarily picked one yet, and that is what I am waiting for in order to make more decisions on what to do in this market. So everyone, we really need to be worried about and really concerned with and focus in on the slowing in economic growth due to these new trade policies and what the Fed and the United States government, this new administration, is going to do to counteract that. This inflation issue that everybody keeps bringing up, as I kind of outlined in this video here, to me, isn't necessarily the biggest problem here, because even if prices start to go up a little bit, you are going to see that demand drop. And then it just leads to even slower growth or even negative growth over those next couple of months that starts to occur. So that is going to wrap up this video here, guys. If you guys did enjoy the information and analysis I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed and turn on notifications so you're notified every time these videos go live. But until next time, guys, I will see you. Peace.